Today on Inspired Money.
With the 401k plan, you can add a profit sharing component, but you're going to be limited to roughly 60 grand a year that you can put in per person. And I mean, that's a decent sum of money. Obviously, it's more than most people would probably want to save in a year. But for those owners that maybe are 50 or 55 and they've spent all their time on their business and all their resources, and now it's time to save for retirement, and they need to put away $100,000, $200,000 a year to make up for lost time, that's where a DB plan can be a really great solution.
This is episode 153 with CEO of Saber Pension and Actuarial Services, Brent Henningson. Welcome to Inspired Money. My name is Andy Wong, a managing partner at Runnymede Capital Management. Each week, we bring you an interesting person to help you get inspired, shift your perspectives on money, and achieve incredible things. From making it to giving it away, Inspired Money means making a difference, creating something bigger than oneself, and maybe, just maybe, making the world a better place. Thank you for joining me. Hey, Inspired Moneymaker, welcome back. If this is your first time listening, welcome. According to a 2020 TD Ameritrade report, most Americans want to retire by age 67. Despite more than half having a plan, nearly two-thirds of 40-year-olds have less than $100,000 saved for retirement. 1 in 5 of those in their 70s has less than $50,000 saved. You get the picture. There's a gap. In this episode, we're talking about a specific retirement plan, the defined benefit plan. And this topic applies to business owners, entrepreneurs, and solopreneurs. If this isn't you, I hope that you'll still find this episode interesting. There are not that many ways to reduce your taxable income and accelerate retirement savings, so it's good to arm yourself with this knowledge. Perhaps you'll be able to help a friend or your family. We're talking with Brent Henningson, CEO of Saber Pension and Actuarial Services. He specializes in defined benefit plans or DB plans. In this episode, you'll learn, if your income allows for it, how to save up to $3 million in retirement savings, the differences between a 401k retirement plan and a defined benefit plan, and the professionals needed to set up and maintain a DB plan. Now let's get inspired with Brent Henningson. Brent, welcome to Inspired Money. I'm so excited to have you on the show.
Thanks, Andy. It's great to be here.
Let's jump right in. What's your earliest childhood memory of money?
My earliest childhood memory is going on vacation with my family, my parents giving all of us kids, we had 5 kids, giving us all money to spend for a souvenir. And my brothers and sisters just blowing all their money on video games and candy, and me just hanging on to that money and really being thoughtful about how I was going to spend it. So I think at an early age, just money, managing money, it really interested me.
Of the 5 kids, you were the one who became the actuary. So everybody sort of had a different personality about money. Do you think that still holds true today?
I'd say they, my brothers and sisters actually gotten a lot better with money. I have the reputation, I guess, of when they have a money question, they usually call me.
So Brent, most people probably don't get excited about actuarial services, but helping business owners to reduce taxes and accelerate retirement savings, that can be really exciting. You're Chief Executive Officer of Saber Pension and Actuarial Services, a third-party administration and actuarial firm. How did you end up in this pretty specialized area?
So my journey's been interesting because I always gravitated toward math, but I just never knew, like in junior high and high school, what I was going to do with it. I decided, so in my freshman year of college, I actually declared pre-law. So I still didn't know even at that point. But when I found actuarial science and saw that it was a profession where it was rated number 1 at the time by U.S. News and World Report, it's just as an occupation that pays well, that has a good work-life balance, and is a pretty stable career. I decided probably sophomore year in college, I wanted to be an actuary, and just gravitated toward the defined benefit space because I liked consulting with clients. I liked the quantitative part. It's just a good mix of being able to kind of interact with people, but at the same time use my mathematical skills. And I spent my whole career, I've spent over 15 years with a really large provider that was a global provider. And their target market was really Fortune 1000 companies. And so I was working on some of the largest plans. I'm in the Phoenix area, some of the largest plans in Phoenix. And, some of them had billions of dollars. And it was really interesting work and I liked it. Between the time I started in 2001 and when I left there, there was more and more focus toward 401k plans. And the industry was a slowly dying industry, essentially, for large employers. And that's when I decided in 2018 to switch over, focus on small plans, because that's really a growing area, and start my own business and kind of be able to build my own vision.
And you started Saber Pension just a couple of years ago?
Yeah, almost exactly 2 years ago. I started in May of 2018.
Let's talk a little bit about that shift. When we talk about defined benefit plans or a pension plan compared to a defined contribution plan or 401k, can you give us a little historical context just as a starting point?
Pensions really came about after they really started making headway, I'd say, after like the Second World War and picked up steam. But then, there was a number of legislative changes that just made sponsoring a defined benefit plan as an employer more onerous. And those changes were really needed because there were employees that were cheated out of large sums of money by large corporations. But at the same time, it did make it more difficult for employers to want to sponsor them. I mean, there's been a lot of factors that have really gone into the shift, but some of them are just the plans started getting really large relative to the size of the organization. I mean, you kind of hear the joke, like when GM had their pension plan, it was like they're a pension company that does cars on the side, because their pension just became so large relative to the size of their company that any changes in the assets or the liabilities would flow through their financial statements. And it was just a disaster to be able to hit quarterly earnings when you have those kind of surprises. So you started seeing employers shift more to 401k plans because they were just easier to predict the cost, and the employers were shifting a lot of the risk to the employees. You
mentioned that the defined benefit plans for smaller companies, that's a growing area. Why is that?
Well, so the motivation behind starting a plan for a large corporation was really attraction and retention. And people just don't stay with employers as long as they used to. So it became less appealing, I think, for employees. But with the small plan market, it's not about attraction and retention in most cases. More often than not, it's about the owner being able to save for his or her own retirement while making large tax deductions. And so it's more of a tax/retirement play as opposed to attracting and retaining employees.
Right. So it's using an older vehicle, but in a different way, it sounds like.
Yeah, in a different way. And it really lends itself to the objective of owners maximizing their own retirement, because with the 401k plan, you can add a profit sharing component, but you're going to be limited to roughly $60,000 a year that you can put in per person. And I mean, that's a decent sum of money. Obviously, it's more than most people would probably want to save in a year. But for those owners that maybe are 50 or 55 and they've spent all their time on their business and all their resources, and now it's time to save for retirement, and they need to put away $100,000, $200,000 a year to make up for lost time, that's where a DB plan can be a really great solution.
So let's talk about that, because putting away $100,000 to $200,000 per year, that's a big sum of money. Who should be taking advantage of this? What does the individual look like? What's the ideal business profile of the clients that you work with who do set up DB plans?
The number one criteria is, are they somehow being limited on the retirement contribution? And so that could be the $60,000 contribution I talked about. Sometimes it can be like, for example, with a SEP plan, you can only put in 25% of your pay. And so you may be limited because of that. And it may be under 60,000, but you're still being limited. I would say, the number one criteria is if you're somehow as an owner wanting to put in more money than you're allowed to, then it's worth exploring a DB plan. I mean, the other thing too is if you have too many employees, then the cost of covering those employees will eat up any value of the tax deduction you're getting. So part of the analysis we do is weighing those two factors against each other.
Does an employer have to offer this benefit to all employees?
You have to provide it to enough employees. I mean, you can usually exclude some employees. You just have to pass what they call non-discrimination testing. But in terms of how much it generally costs, my rule of thumb is 8 to 10% of staff payroll. And so it's not really a headcount thing. It's more payroll, because if you have 10 employees and the average salaries, they're $10,000, $20,000 because they're fairly part-time, it may be a lot easier to accomplish than having 5 employees who are getting $100,000. I mean, there are cases where if someone's making more than the threshold, which is $125,000 a year, you can exclude them, and that actually helps you rather than hurt you. But for most employees, it's going to cost like 8 to 10% of payroll.
Okay, so that's a good rule of thumb to go by. But I guess if somebody were like solopreneur, does that make it just an even easier analysis if there's just one person?
Yeah, I would say that's definitely the ideal, because now every dollar that they put in is going to themselves as the owner. And if they have a spouse that is employed at the business too, that's even better, because they can double up that deduction in some cases.
So if you have like one professional owner of the business who's making the lion's share of the payroll, and there's an assistant or 2 assistants, it sounds like, given your rule of thumb, that shouldn't be too onerous. You're not creating massive complexity if you have a small staff, but you have an owner plus 1 or 2 assistants.
Yeah, that's absolutely right. I mean, if you have an owner and 2 assistants, that generally is going to make sense. I mean, there's an age component too. And kind of going back to how defined benefit plans work is, with the 401k, you're defining the contribution, just like the name defined contribution says. Like, you can put in $19,500. You can do that every single year. But what that contribution ends up being worth at the end at retirement is anybody's guess, because it's going to be based on what the market earns really and what they invested in. With a DB plan, it's the exact opposite, where you define up front what the benefit will be at retirement. And for an owner who wants to max out, that could be almost $3 million at age 62. They could get a payout of roughly $3 million. You can imagine someone who's, let's say, 50, and they have 10, 12 years to get to that horizon. They can put in a lot of money to get to that $3 million. Someone who's younger, let's say someone who's 25, and they have like 40 years to get there. It's the contributions for someone that young usually aren't going to be worth it. Usually they need to be at least, I would say, late 30s or early 40s for it to make sense.
But it does come down to how much income there is also, right? So if you have like a 30-year-old who has an online business, for example, and they're generating a lot of income annually, it may make sense to set up a DB plan. I guess, to what extent does the age, how important a factor? Because I know that does come into play when calculating how much one can put into it.
Yeah, I'd say the big thing is, so for example, at age, let's say 40, someone can put in about $100,000 a year. If they're younger, like 35, maybe it's $75,000. But if you get too young, if you're 30, it could be about the same amount that you could put in a profit sharing plan. So it's sort of like, why would you pay the extra money to administer a defined benefit plan when you can get to the same place using another vehicle that's easier?
Right. That makes sense. So it's not black and white. It does take some analysis, some crunching the numbers on a case-by-case basis to see if it is optimal for that individual.
Yeah, absolutely.
When you're working with clients to set up these plans, are there certain professions or industries that really stand out as being a great fit?
Yeah. I mean, the industries that really, I would say, utilize these plans are physicians, dentists, lawyers. So, I mean, those are kind of the traditional users of defined benefit plans. But and we have a lot of, our economy's changed a lot. So we have a lot of consultants. And that's where I pick up a lot of clients too, is all kinds of different consulting. They could be consulting on digital marketing, branding, there's just any kind of consulting. There's a lot of opportunity for them to make a lot of money. And a lot of times they're on their own. They may have one employee, they may not. And so they're a really good candidate as well.
Does the source of income matter? I remember someone once telling me that a DB plan makes sense for someone who has a secondary source of income, whether that's doing consulting on the side or a paid board member compensation.
Yeah, I mean, so I actually have a whole blog post about what I call this side business defined benefit plan. And it's the reason that works really well is because a lot of times that income isn't needed for the person to live on. So it's like they have their full-time job, they live off of that. Either that or maybe their spouse has a full-time job and their family lives off that. And then they have this business on the side that they, it's essentially could be used all for retirement or most of it for retirement. And that's where, like, when you look at that income and the percentage of income that can be saved in a DB versus like a 401k plan, sometimes someone can almost save all of that money in a DB, whereas in a 401k, they're going to be limited to roughly 25% of pay. And so I've had situations like that where someone's 40 and they're making 100,000 and they want to save most of that, and they're able to do that in a DB plan.
That's because in this example, you're looking at the 100,000 as a secondary source of income that's not really needed.
That's right. Yeah, they'd like to save as much of that as they can, but the 401k limits won't let them do that.
Right. And then since we were talking about kind of things to look out for, I know that defined benefit plans are different from a 401k in that there's a requirement for the company to contribute. Tell me if that's correct, incorrect, or how that plays into the decision when considering a DB plan.
Yeah, it's absolutely correct that in most years, there's going to be a requirement to put something into the plan. And how much they have to put in is what, an actuary like me determines is, you have this, if you think about it, how it works is you have this liability, we talked about, you define the benefit up front, you have this liability. And then at the same time, you have money you're putting into a retirement account, that's the asset backing that liability. And they don't have to be equal. In fact, they can stray from each other quite a bit. There's a lot of flexibility on how that liability is funded, but there is parameters around a minimum amount you have to put in to fund it. There's also parameters around a maximum amount. And so to give you an idea, on the maximum side, you can fund 150% of the liability. So in good years, I encourage my clients, if you've had a good year, fund towards that 150% of liability so that if you have a lean year, that's going to make the minimum requirement a lot lower. In fact, it could even make it zero.
With that consideration, if there's a stock market crash, does that create a scenario where the sponsor of the DB plan would have to contribute more to make up for that?
It's more complicated than it sounds because it depends on the funded status of the plan too. If it's a really underfunded plan, they just amortize that over a 7-year period. And so it's not too big of a deal. But there is this corridor where if they're in that corridor, it can be a dollar for dollar impact, at least for part of it. And that's why I always encourage clients to work closely with a financial advisor, because I can't give financial advice as an actuary. I'm not a licensed advisor for managing money, but typically advisors are not recommending that their clients be in 100% equity because of that volatility component.
Got it. Yes, I'm a financial advisor, and we have worked with clients managing their DB plans. So yes, there's a definite need for prudent investing. Since we're talking about the requirement to contribute every year, it sounds like it's important to have a regular source of income. Like, it should be fairly consistent. Does it make sense for somebody who is an actor or a screenwriter or a speaker? Because sometimes their income can be variable year to year.
Yeah, I mean, I would say that it's ideal for someone to have a consistent stream of income. I have clients, though, that, for example, are attorneys, and they'll get a large settlement one year, and then they may not make much money at all for the next couple of years. And so that's where knowing up front that the income is going to be irregular, we can design the plan so that we don't set the bar too high and then they overfund it. And then that way they can kind of, and even set aside some money for the next couple of years for making that minimum requirement. But I mean, there is the ability to freeze the plan if needed. It's just that you can't retroactively cut back a benefit. So you have to have some foresight that, the next couple of years might be lean. Let's freeze the plan. Then we'll kind of see where it goes. So, it's just nice knowing all that up front so that we can design the plan to meet that objective.
As is the case often with money, communication's important because you need to do proper planning, and that holds true with the defined benefit plan as well.
Yeah, that's absolutely right.
Coming up, a couple case studies. Can a DB plan work alongside a 401k? And how long DB plans usually exist? All that and more right after this short break. The show notes for this episode can be found at inspiredmoney.fm/153. If you're listening in your car or wherever you are, check the show notes if you want to learn more about Brent, his business, and all other things mentioned in this episode. It's time for the Runnymede Money Tip of the Week. We've talked about maxing out your 401k retirement plan contributions and making sure that you're taking advantage of your company match. But what if you're the business owner? Hopefully you're making your annual pre-tax contributions. The current limits are $19,500 a year as of 2020, with an additional $6,500 in catch-up contributions if you're over age 50. That means along with your employees, you could be reducing your taxable income by as much as $25,000 per year. If you adopt a safe harbor 401k plan, which involves making a standard contribution to all employees, regardless of how much they contribute to the plan, or matching contributions that meet the safe harbor requirements, and there are other plan types like profit sharing, which allow you, the business owner, to save as much as $57,000 per year before taxes, or $63,500 per year with the catch-up contributions. As a business owner, you have additional benefits. There's a tax credit available for many small businesses with 100 employees or fewer, starting a small business 401k plan for the first time. If you qualify, you can get a $500 credit for each of the first 3 years of a new plan. You can also take business expense deductions on any plan management expenses you pay and any matching contributions the business makes to employees participating in the plan. Since we opened this episode pointing to the retirement gap that many Americans have in their retirement readiness, what are a few more things that you can do to improve your 401k plan? Number 1 is increase employee education. The earlier employees feel empowered to take advantage of their retirement plan and start saving for retirement, the more likely they're going to be better prepared. 2, add an auto-enrollment feature. With this feature, rather than opting into the plan, employees have the option to opt out of automatic enrollment. It's easier for business owners and other highly compensated employees to save as much as they like in their own accounts when more employees choose to participate. 3, look closely at your plan fees. This is important for a couple of reasons. First, the fees of the funds in your 401k directly impact the investment performance for you and all employees in the plan. Second, if you're the owner of a company and you're the plan sponsor, you have a fiduciary duty to review the fees regularly to make sure that they're reasonable. Number 4, invest wisely. Review your own fund choices and allocation to make sure that they're aligned with your goals. For example, if you're retiring in 5 to 10 years, you probably should not be invested 100% in stocks. If you need help with any of these things, I can help you to review your plan's investments and fees. We do this regularly for our clients and prospective clients. Remember, it's not only important for you to plan for your own retirement, but to help your employees be retirement ready. If not, it could mean employees who should be retiring being forced to work longer. You don't want employees working well beyond when they should because they're likely to be less productive and you'll be paying healthcare benefits. We can all assume that those costs are not going lower. If you're interested, send me an email at inspiredmoney.fm/Andy. The review process is an easy one, and I'm happy to help. That's the Runnymede Money Tip of the Week. Inspired Money is brought to you by Runnymede Capital Management. We help you to plan, invest, and worry less. Our Inspired Moneymaker of the Week is Golden Voice 63, who wrote a review at Apple Podcasts. Golden Voice wrote, "Great investing podcast. Andy's great with providing informative information to his listeners. I enjoy listening to this podcast on a daily basis. I started listening a year ago when I began learning about investing. Andy offers well-reasoned and insightful comments about current market trends. He explains things so that beginners can understand. But the show is definitely useful for the seasoned investor as well. His variety of guests speak on a wide range of topics." Golden Voice 63, first of all, great screen name. I'd love to hear your podcast or your music, depending on where your name comes from. If you're listening, go to inspiredmoney.fm/Andy and please send me an email. I appreciate you taking the time to write a review. I'd love to mail you a copy of Chemo West CD and an Inspired Money sticker. So Inspired Moneymaker, if you're liking this episode, take a screenshot of it right now on your smartphone. I'm looking for classic movies that are great for kids. For example, we recently watched Back to the Future and Cool Runnings. Okay, maybe these are not classics, but I don't think my kids are ready for Gone with the Wind. Please share your movie recommendation, appropriate for kids or not. I'd love to add your recommendation to my list of things to watch. Share it on social media along with the photo of this episode and tag me. I'm inspiredmoney.fm on Instagram or Runnymede Cap on Twitter. That's RUNNYMEDECAP. Don't forget to use the hashtag InspiredMoney. Or if you want to share your movie recommendation, not so publicly, email me at inspiredmoney.fm/Andy. I'd love to hear from you. I'd love to give you a shout out here on a future podcast. You're listening to Inspired Money. I'm Andy Wong. Brent, we've talked about what industries DB plans are pretty common, why somebody would consider a DB plan. Can you share with us maybe a case study that of somebody that you've worked with and how it makes sense on a practical level?
Yeah. So I'll give an example of someone that has employees because that's a little more complicated. And I think when they're a high income owner only, it's almost a slam dunk if they want to save a lot. But when somebody has employees, I have example where let's say somebody is 55 and they want to save as much as they can. And for somebody that age who's 55 years old, they might be able to save $250,000 per year in a DB plan. And then if somebody like that had payroll of, let's just say $50,000 in staff payroll, then, kind of thinking about how that works. They put in $250, let's just say, that they're going to get like a 40% deduction when you take into account federal, state, any, QBI, that the qualified business income deduction that could come into play. Let's just, to make the math easy, say it's 40%. So somebody like that could save $100,000 in taxes. And if they had staff payroll of 50,000, using my rule of thumb of let's use 10% of payroll, that would cost them $5,000 in staff benefits. And so when you compare $100,000 in tax savings to $5,000 in staff benefits, I mean, clearly it makes sense for somebody like that to put in a plan.
That is compelling.
Yeah, it is. I mean, it's really the biggest barrier is just how much you want to put in, because there's situations where that exact situation, but it's like, oh, I only want to put in 30,000, and it's like, okay, that's fine, but you shouldn't do a DB plan because a profit sharing plan is going to meet your needs. So just stick with that.
When you work with your clients, do you see them using a 401k in conjunction with a DB, or is the DB an alternative to a 401k?
Usually in conjunction, because in the owner only example, if they're over 50, they can put in $26,000 in addition to the DB plan. And they can also do a profit sharing contribution of 6% of their pay. If they do more than that, it messes up the DB deduction, but they can get in more money doing both. And they can just use like a solo K. So they don't even need to pay a third party administrator to do that. So usually it's in conjunction. If they have employees, my experience is it's about 50% of the cost to use what's called a defined benefit, defined contribution combo plan, which is kind of passing non-discrimination testing using both types of plans. And so the 8 to 10% takes into account that that's the direction they would be going. If they were doing a standalone DB, it might be 15 or 20% of payroll. And so it's almost always going to make sense to use the 401k in conjunction.
At Saber Pension, do you get involved on the 401k side too? Do you handle that for clients who have the combo plan, or are you specifically addressing the DB part of the work?
So yeah, I just specialize in the DB portion, but I do the combined testing, the combined non-discrimination testing between the two plans. And then there's, a handful of third-party administrators who specialize in just 401k plans that I'll partner with, and we just work together to help the client with their retirement plan.
Okay, so let's talk about the typical service providers. Who are the professionals needed to set up a plan and to maintain it?
So, obviously the third-party administrators, and with the DB plan, you need an actuary too to sign off on it. So I do both a third-party administrator and the actuarial role. They would need, or at least I would highly recommend, that they have a financial advisor, especially if they have employees, because they're going to have a fiduciary responsibility to manage that money. So that would be another team member. Then, obviously you have like the CPA that would be involved, because we're dealing with taxes. And you have the custodian, and the custodian is, let's just give an example, like a Schwab or Fidelity or whoever the advisor uses for a custodian. That firm would actually hold the money and usually keep track of how much the investment's earned in terms of like what the account balances are. And then in some cases, you need an ERISA attorney. And I would say in most cases you don't, because these plans are, if they can use a pre-approved plan like the one that Saber Pension uses, they don't need one. But occasionally you do run into situations where we need to get just like an attorney's advice on a more complicated situation.
So this is why defined benefit plans have your reputation for being more complex. In your view, how complex is it really for a business owner to implement, fund, and manage on an ongoing basis?
Well, so, there's a lot of complexity, like you say. 401ks have a lot of complexity too, but in a different way. And I think because people are more familiar with them, they don't seem as complex. But part of it is when you hire a third-party administrator, they know all the complexity and the rules, and they make sure that the business owner has all the information they need to comply with that. So obviously the business owner, just like they don't have to learn the tax law, because taxes are extremely complicated. The CPA helps them understand what they need to do. That's kind of like my job, to make sure that they check all those boxes so they don't get into trouble. And I would say, towards the end of last year, I had a lot of prospects reach out to put in a plan, because that used to be the deadline, is the end of the tax year. And some of these plans, we were designing them and adopting them within a week. So, they can be done quickly if somebody's if they're ready to move, they can be done really fast.
Are there dates that people need to consider?
Well, so the Secure Act changed the due date when you have to set up the plan. Like I said, it used to be the end of the tax year. And now it's basically the date when you file your taxes for that tax year. So if you have a calendar year S Corp, let's say, and they extend their tax return all the way until 9/15 of 2021, they would need to have the plan implemented by that date to be able to get a 2020 tax deduction. They would also, it kind of made it a little more complicated as well, because not only would they need to have it implemented, they would have needed to open the retirement account, funded it, and then a month later, the TPA would have had to file the Form 5500. So it essentially kind of created opportunity for clients to know where their taxes are before deciding to put in a plan. But it also caused some logistical issues for those who waited until the very last minute.
Do you have another case study example that we should think about?
Yeah, I mean, one example that comes to mind was, and this is what I would call this would be an unusual situation because it's so compelling and so good. But I had a business owner who was in their 60s. Their spouse was also an employee of the business, and they had no employees. And this person had a large stream of income coming in year one, and that income was going to continue, but it was going to continue at a lower rate. And so what they were looking for is the largest deduction possible. They wanted to front load the contribution stream, kind of fund it at 150%. And so the solution that we came up with was, okay, let's do a defined benefit plan. You and your spouse will be in the plan. You're going to do a 401k as well and max that out to the extent you can and front load those contributions. And they ended up being able to deduct in year one, it was roughly $900,000. It was just, it had to do with the amount of income, the fact that they were close to retirement, and that the spouse was also employed. And so that would be kind of really, it's totally within the guidelines of what you're able to do. It's just all those aligning to create a deduction that large is pretty unusual.
Brent, to what extent does that open one up to a potential audit?
Yeah, I mean, I don't think it really, and I don't have any statistics because it's hard to get those statistics, but I would say that it wouldn't really increase or be a red flag in terms of creating an additional scrutiny on the audit. For a lot of these plans too, where they're owner-only plans, they don't even file anything until they have over $250,000 in assets. So it's the good thing about these type of plans is actuaries have done a really good job regulating themselves. So we have, actuarial standards of practice. We have a disciplinary council, and actuaries typically have the personality to kind of do the right thing. And so because of that, there hasn't been a big need to just scrutinize all the work that actuaries do. I mean, there have historically been, in the 80s, there was kind of a big shakedown with the IRS just targeting these type of plans. But since then, there just hasn't been anything that's really notable.
Yeah, it seems like one of the few places where one can actually get a tax benefit, increase their retirement savings, and it's all done pretty clearly within the regulation of the law.
Yeah, absolutely. And when owners have employees, it's really good for the employees too, because like I said, if they're getting 10% of payroll for really not doing anything additional, that's just the cost to play, I guess, for the owner. A 10% retirement benefit is really significant. So it's not as if the owners are the only ones benefiting. I mean, anyone who's employed and is getting this type of arrangement is really fortunate.
Yeah, that sounds like a win-win.
Yeah, absolutely.
So I really appreciate those examples. It makes me think of another major difference between the traditional pension plans of a GM of the past versus for a smaller business. And that's that old pension plans, they're always viewed as having an investment horizon of almost forever, because you've got a large company that is going to be in existence more than a generation of one employee. It's going to continue for the lifetime of that corporation. That's different for a small business, right? I know that people talk about a permanency rule. Maybe you can talk about how long do small business owners tend to keep their DB plan?
Yeah, I would say kind of on the maximum end of the spectrum, usually it's going to be about 10 years. And the reason for 10 years is because the maximum benefit limit, it phases in over 10 years. So if someone's maxing out their amount every single year, after 10 years, they're going to kind of be at their limit. And then there's really no reason to continue to maintain that. So somebody like that would terminate the plan and roll it over to an IRA. And then the kind of on the lower end of the spectrum, it's a good idea, I would say, to have the plan open for 5 years. I think that's pretty safe to satisfy that permanency rule. 3 years is starting to get into kind of a gray area, and anything below 3 years, unless you have a really compelling reason like going out of business or just some, major financial shock, it's going to be hard to justify to the IRS that this was meant to be a permanent plan, because it's going to feel a lot more like a tax gimmick.
What does the permanency rule say?
It's actually pretty vague. But in practice, what we've seen in practice is, like I said, 5 years is pretty safe. So it doesn't actually define what permanency means. And when you think permanency, you think it essentially goes on forever, right? But clearly, that's not the case with these smaller types of arrangements. I think it's just, if you go in with the expectation that you're going to fund this for 2 years and terminate it, if anyone comes to me with that, I just tell them straight up, like, that's not a good idea. You really should plan on having it open a lot longer than that.
So people should be really setting a goal of hitting that maximum for the DB contribution, and then they're rolling it over into an IRA, or 5+ years is viewed as safe.
Correct.
So all of this was very informative and helpful. Can you talk a little bit about, like, if someone wants to start going down the road of exploring if a defined benefit plan makes sense for them, what does that look like?
Yeah. So, usually the first step is just to see what the numbers look like. And so they could call somebody like me or another TPA or actuary, and, with some data, usually like a census, so showing sort of, their employee payroll, birth dates, hire dates, then a TPA could run some numbers to show what the deduction is for the owner, what the staff costs would be, and then kind of comparing the value of that tax deduction, usually like at an illustrative level, because we're not looking at their taxes, and then showing what the cost of the staff benefit is to help them determine if it makes sense to explore it further.
And then it's a matter of, I guess, setting goals. What is it that they want the plan to achieve, and maybe what the time horizon looks like?
Yeah, so it's exactly. The objective is pretty similar from my experience. Like, usually the objective is to maximize the defined benefit and meet the statutory guideline on staff benefits. So it's kind of like trying to weight the benefits to the owner. But there are cases where the owner says, hey, I really want to take care of my employees. Like, I plan, their family, I want to take care of them. They tend to stay with me. And so there are situations like that where the benefit is more equally distributed. There's a lot of regulations, though, in terms of how you have to distribute those benefits. So it's sort of like layers upon layers upon layers of rules to make sure that the staff is being treated fairly as well.
Are there big differences state by state that need to be considered?
Not for these type of plans, because it's really governed by the Internal Revenue Code and by ERISA, which are, federal guidelines. I heard recently from a CPA who had a client in New Jersey that, any loss created in the corporation because of a defined benefit deduction it couldn't be applied against other earned income that they're receiving as a full-time employee somewhere else. So you do have little nuances, I guess, in the tax code state by state, but in general, no, it's more of a federal patchwork of rules and regulations.
Yeah, and since this is the Inspired Money podcast, this sounds like a way for business owners to sock away more toward retirement, save taxes, and it really becomes a vehicle where they can be more intentional and be more impactful with their money.
Yeah, that's absolutely right. Like, when you have the right candidate, this this is almost a no-brainer.
Can you give us a ballpark idea of what expected costs and expenses there might be?
What I tell people, it varies from TPA to TPA, but, kind of in general, it costs a couple $1,000s to start a plan. And then, for a one person plan, it's going to be between $1,500 and $2,000 a year to maintain it. So maybe when you go back to the example that I gave at the beginning of the person saving $100,000 in taxes and costing $5,000 in staff benefits, if you add, another $2,000 to sort of maintain the plan, it's just still really compelling.
I think when you look at all the figures nationally, as far as are people retirement ready, people need ways to sock more away. So if people are so fortunate to be generating enough cash flow that they can put more away, this sounds very advantageous.
Yeah, and it's one of those solutions too, because there's other solutions you hear of that they have compelling tax benefits, but they're really expensive to implement and maintain. And they can still make sense, but it's nice to have a solution that is fairly cheap to set up and maintain.
Any other drawbacks that people should be aware of?
Yeah, I'd say the biggest drawbacks we've covered are just it's more commitment. Putting in money every year. It's minimizing that asset volatility, like we talked about. Those are where I see people get into trouble. It's when they're not aware of those things. And so, whenever I talk to someone who's interested, those are points that I raise immediately because, obviously I don't want any surprises as they continue to maintain the plan.
And then I like to ask all the Inspired Money guests, how do you define success? So I will address that to you as a relatively new business owner and somebody who's working with clients and helping them.
So, there's different definitions of success. And so, how I view success kind of holistically is different than how I view it as strictly business owner. Holistically, I look at, doing a really good job for my clients. I'm a father of 3 daughters, so being there for them, that's a high priority, obviously. But then when we talk about business specifically, I would say, when I can help somebody achieve what they're trying to do and be consultative in a way that, helps them meet that objective more efficiently. And just one thing I really pride myself in is I get told a lot by my clients is like, wow, you're just really nice. You took the time to explain this. I really appreciate that. And, that makes me feel good because then I know that I'm helping that person to understand these type of vehicles and how it can help them plan financially.
Brent, tell us, where can the Inspired Money listener find out more about you and your company?
So they can go to my website, which is saberpension.com. And that's spelled S-A-B as in boy, E-R pension.com.
Thank you for sharing a wealth of information that I think that a lot of people can benefit from. And it sounds like if people are interested, it will require a little bit of homework, but it could be very worthwhile.
Yeah, it does take a little bit of time up front, but when it makes sense, it's a really good way for them to put away a lot of money. So it's been really great to be on the show, Andy. I appreciate you having me.
So what was your favorite Inspired Money moment? Thank you for listening this far. Did you catch what Brent said about being able to fund 150% of the liability? In good years, fund the maximum so that if you have a lean year, your minimum requirement is a lot lower. Whether you're talking defined benefit plan or not, this is a great takeaway. When times are good, save for that rainy day. Planning ahead can make things much better when you need it. Okay, Inspired Moneymaker, if you like this episode, take a screenshot right now of this podcast on your smartphone. Share your movie recommendation that I can watch at home on Netflix, Disney+, Amazon Prime. I'd love to add your recommendation to my list of movies to watch. 2 documentaries that I liked was Memory Games on Netflix and also Short Game. That's a documentary about the world's best 7-year-old golfers competing in the World Championships of Junior Golf. Share your screenshot and movie on social media. Tag me. I'm inspiredmoney.fm on Instagram or Runnymede Cap on Twitter. That's RUNNYMEDECAP, short for Runnymede Capital. Don't forget to use the hashtag InspiredMoney. Do that now, and I'll mail you an Inspired Money sticker, button, maybe both, and give you a shout out on a future episode. Inspired Money is edited by Christopher Wright of Wright Media. Thank you so much for joining me. If you're not yet subscribed, hit subscribe right now. That way you won't miss next week's episode. I look forward to seeing you then. The music you're listening to right now and all other music on today's show is by the amazing Jim Kimo West. Have an inspired week and do something that scares you, because that's where the magic happens.